Okay. Hey, it's 10 o'clock. Hopefully you can see me. This is the session. There may be another one out there. So if you're not joining that, join this one, the one that's actually live. Let me know that you're here so I can know you're here. It's just comforting. I'm not sure it matters a whole lot, but I'll feel better. There's Sydney Green. All right, she's here. Let's get 2 or 3 more people. Hannah, Aubrey. All right, nice. Let's get 40 other people and we'll be ready to go. There we go. Annie, Haley, Alondra. All right, you guys are doing great. I'm trying to hang in there. This is fun, different. I don't know, very weird. There's no one in here, of course, except for me. School's kind of blank. Okay, is my screen good? I think it is, right? You can see the vast majority. Yeah, I can see. I'm kind of having to look here, and it's a little strange. All right, so this is what we're going to talk about. We're going to talk about consumer choice. So we're going to hit elasticity pretty hard, a little bit about surplus efficiency and deadweight loss, tax incidence, utility maximization. So we're going to talk about all those things. We'll have you do a little bit of work, but not too much. We're going to be out of here in 30 minutes. Okay, guys, when 30 minutes are up, we'll call it. Okay. And so hopefully, Lanassa, did you find us? She did. Cool. She found us. I see her on the list here. And more people. Jessica, Sophie. How you doing, Sophie? You guys keep inviting those first semester kids here. We're going to get them passed. Okay. So let's talk about elasticity. Good stuff. Okay. Elasticity is about how bad do you want it. Okay. And if we raise the price, will it really matter to you? And it turns out with really inexpensive things that you feel like you need, they tend to be inelastic. You can see eggs and beef and gasoline and stuff like that is inelastic. And then it turns out with really expensive things, even maybe if you need them, like housing, it's like if you raise housing 10%, that might be $100 a month. So that's a lot of money. But restaurant meals, airline travels, things you don't have to have tend to be elastic. So things I have to have, demand is inelastic. Things I don't necessarily have to have or are really expensive tend to be elastic. Okay, so that's just kind of the thought process. We need to remember, right, inelastic, vertical, right? There's inelastic, it forms an I. Elastic forms an E, it's horizontal, perfect. This is perfectly inelastic, perfectly elastic. The other thing that you need to know, okay, is elastic is your coefficient's greater than 1. And what that means is that when you change the price of something, people react in a significant manner. That's elastic because you got quantity up here, right? Change in quantity, percent. Change in quantity up here, percent. Change in price. So if you change your price by a certain percent, let's say you raise the price by 10%, but people buy 20% less stuff, that makes it elastic. If this were eggs, you raise your price 10%, people might only buy 2% less eggs. And so that would make it inelastic. So elastic greater than 1, inelastic less than 1. In other words, not much impact. I changed my price and it turns out the quantity doesn't do a whole lot. And unit elastic is equal to 1. So exactly 1. Who else Ariana. All right. Tamira. Cool. Cole. Welcome back, Cole. Hey, Cole, you need to send me a joke every day that I can tell at the beginning of this because you're way funnier than I am. So make sure you do that. Just text it to me every morning and then I'll tell everybody. Okay, so what do these things look like? Perfectly inelastic. I. Inelastic. Inelastic demand. Pretty relatively vertical, but not perfectly vertical. Perfectly elastic. That forms that E, right? Kind of almost looks like an E. And elastic means that it slopes gently down. So this is relatively, right? Relatively inelastic and relatively elastic. So that pretty simple concepts. Now, a couple of things you need to remember when we get to our actual graphs, right? This is the elastic portion of the curve. And if we look at marginal revenue, right? Here's our marginal revenue. Well, marginal revenue goes to 0 right here. That's the unit elastic amount. Then all over here is inelastic. We never operate in the inelastic portion of the range, because if things were inelastic, we could simply raise our prices and we'd make more money. And I promise you, any business that all they have to do is raise their price to make more money, they're going to raise their price. Okay, and Cole said he'd take care of that, so awesome. Thank you, Cole. All right. Also, we have the total revenue test. Remember the total revenue test? Yeah, you wouldn't believe the setup I have in here. It's a mess. But in total revenue test, if I raise the price, what happens to my total revenue? It goes up. Well, that's inelastic. See, I form a little eye here. Can you see me? Does it look like an eye from your point? Yeah, it does, kind of. Okay. And then if I lower the price, the total revenue lowers, also forms an eye, that's inelastic. If I raise the price, but the total revenue goes down, that's not an eye. Or if I lower the price and total revenue goes up, yeah, also not an eye. So those two are elastic. So the total revenue test is really simple, and we're going to do a little example of it real quick. Okay, remember you can do the average method. Okay, I wouldn't worry too much about that, but if you like that one, feel free to use it. Instead of just a change, you use the midpoint, kind of, so to speak. And you guys, many of you might remember that from math class. We're going to move on. Okay, things I want you to focus on. Okay, this is kind of important here. Price elasticity of demand. It's always percent change in quantity, percent change in quantity, percent change in quantity. Quantity is always on top. Okay, what's on the bottom? Well, whatever they tell you, right? Price elasticity. Well, then that's percent change in price. Income elasticity. Well, then on the bottom is percentage change in income. Cross price elasticity. Well, then it's still the quantity, but of the other item, and then the price of whatever you have or whatever you're looking at. In the case of, in other words, if Pepsi changes their price, what happens to Coke's quantity? Okay, that's cross price. So it's got to be the price of one thing, but the quantity of the other thing. And why is that important? Well, because our competitors do stuff all the time. And when they do things, it affects us. And likewise, if we do something, how might it affect our competitors? And so that's why cross price elasticity is important. There's also elasticity of supply and all, not a big deal. Elasticity of wages, not a big deal, but they would work the same way. Okay, so, and you guys send me questions. I'll check every once in a while if something doesn't make perfect sense, and I'll try to expand a little bit. Although we're trying to move quickly because at 10:30, we're going to be done, okay? We're going to do half-hour sessions, and we're just going to have to figure it out because I'm not going to keep you any longer than that. I'm sorry about yesterday. That took too long, but you got to remember, I'm just kind of figuring this stuff out. I'm doing the best I can. As you can see, I got dressed up for you guys. I'm not in my bathrobe and slippers, which I know you appreciate. And I'm going to do that every day because I'm working and I'm getting paid, and I'm happy I'm getting paid, and I'm even happier I'm working because I need something to do. I would go crazy hanging around my house. We're not going anywhere. So let's do this real quick. Okay, total revenue test. Total revenue test is super easy. Okay, look right here. What happened to our price? It went up. Okay, so price increases. Now we need to know what happened to total revenue. Well, the old system, 8 times 10, that's 80. 9 times 8, that's 72. Well, the total revenue went down. Therefore, it's elastic. If it's elastic, our coefficient better be greater than 1. Well, let's check that, okay? Remember, it's always quantity on top, price on the bottom. So we're going to look at price first. What happened to the price? Well, it went up $1 out of 8. So it went up $1 out of 8. So that gives 1/8. That actually, the percent, that's actually 12.5%. So that's the percent change in price. But you don't need to calculate that. You can just look at the numbers and figure it out 90% of the time. Now let's look at the quantity. Well, the quantity began at 10. How much did it change by? Well, it changed by 2. So that's all percent change is figuring out the change divided by where you began. Well, 2/10 is bigger than 1/8. So that number is going to be greater than 1, right? Has to be greater than 1. Well, if it's greater than 1, by definition, it's elastic. How about that? We did them both correct, and we got elastic for both. So that's exactly what we needed to get. Moving on. Okay, everybody good? If you have a question on that, we can come back and check it real quick. But it's like these concepts, and remember, there's videos out here on all this stuff. So you always can go back to look if you'd like to. Okay, real quick. We have a price floor at $13. We're going to calculate consumer producer surplus and deadweight loss, okay? First of all, consumer surplus. Well, this is our price, right? So we're talking about this situation right here, okay? So our consumer surplus is just that amount, okay, because of the price ceiling. So the consumer surplus, we need a triangle, right? So it's 1/2. Well, the distance from here to here, 16 to 13 is 3 times 3. And the distance from here to here is 4 times 4. So that gives us 6. Producer surplus. Well, because it's a price floor, the price is really high. All of this is producer surplus. These guys are producing it. They're getting to sell it for this really high price, which they think is awesome, I'm sure. And so you measure this entire thing, 13 minus 4. Okay. No, can't do it that way. We got to measure this part right here first, because that thing was kind of a weird shape, so we're not going to do that. So 13 minus 7, so that's 6. This is a rectangle, not a triangle, times 4. Okay, and so that's 24. And we also have this little amount right here. That is a triangle. So 1/2 times 3 times 4. And so that would equal 6. And 24 plus 6 is 30. Okay, so you see we had to combine these two to get producer surplus and then deadweight loss. And you're going to have to do this on the test. Expect calculations, okay? $6. Okay, that's $6. So this right here is $6. The distance from 4 to 8 is 4. That is definitely a triangle. So 1/2 times the base of 6 times the height of the triangle of 4. And so that one equals 12. Okay, so you can do that, and we got that just like that. Cool. Moving on. Okay, here we have an excise tax. This is one of those things that you definitely want to know. Okay, excise tax always shifts. I don't like it when they do this. Shift supply to the left, it hurts supply. Okay, so how do we look at this? Well, with the new curve, this is our new amount, right? This is the amount we did have. Here's our new amount. The excise tax reduces the quantity, and our price was at 80. It's now 100. Okay, so we're going to have less quantity. We're going to have a higher price. We're going to hurt. Remember, we had all of this as surplus. This entire thing was surplus. So we're going to have less surplus because there's our consumer surplus. Our producer surplus is here. And then our tax amount, the total tax is right there. And then what's this guy right here? You know that. You can answer that up to yourselves there. And that's right. That's deadweight loss. You got it right. I'm sure you did. Okay. Quick examples. What if demand is inelastic, right? This is demand relatively inelastic. Well, the demand is pretty vertical, right? And the supply is pretty horizontal. We were paying $2. The price goes way up to $2.95. The tax was $1. So we have an excise tax on this gasoline of $1. Well, the producers now receive $1.95. So who pays most of the tax? Well, most of the tax is paid by consumers, right? Because the price went from $2 to $2.95. So when things are relatively inelastic, when you have to have them, and it doesn't really matter if the price goes up, then you're going to end up paying most of it. Consumers pay the most of it. What if it's the other way around? What if it's like fast food and one of the fast food people tries to raise their prices? Well, I'll just go to another fast food place. And so what will happen in that case is you can see demand is pretty flat, right? Not horizontal, but pretty flat, whereas supply is pretty vertical. Well, in that case, this was $6. The price only goes up to $6.50. The tax in this case was $5. Okay, and you take $6.50, find your amount right here. It's $5. Okay, or $5 less. $6.50 minus $5 is $1.50, and so the producers pay the vast majority. So if demand is relatively elastic, we get a break. If demand is relatively inelastic, then we pay big time. Keep moving. Okay, so now we're going to do our calculations real quick here. Okay, so we've got this tax. And so the tax, and I'm going to draw the supply one. Here's our new supply graph. Here's an excise tax. The excise tax is $40 per hotel room. What happens in this case? Okay, we're going to set up equations only for consumer surplus. Well, our consumer surplus is going to be right here. There's consumer surplus. So it's 1/2, because it's a triangle, times the distance between these two. We're paying 100. These people are willing to pay 120, so that's $20. And then we have to find the quantity. Down here, the quantity that's going to be sold is 5,000 times 5,000. So that's consumer surplus. Okay, producer surplus. Exact same calculation, right? The difference is 20 here, still 5,000. It's still a triangle. So your producer surplus in this case is going to be exactly the same. So it's also going to be 5,000. Okay. In addition, find the check tax revenue. Well, that's that box right there. Okay. So that's $40, 5,000 units. So literally, and that's not a triangle. That's a rectangle. $40 times 5,000, and that will give you your answer for that. And finally, total revenue. Okay, now this one's a little tricky because total revenue doesn't include taxes. No producer's happy because they collected taxes. Okay, so they only get $60, right? Our producers receive $60, so it's this square right there. There's total revenue. Total revenue is $60 times 5,000 units. So that's our total revenue. That's our total tax. And then you can see consumer and producer surplus. And then we could also calculate right here, deadweight loss. Well, there's our deadweight loss, another triangle. Well, that triangle has a base of 40, a height, the difference between these two numbers, right? So 10,000 minus 5,000. And then since it's a triangle, you'd multiply that times 1/2. Okay, so that's how you would calculate all of the different components of an excise tax. So it's like, that's probably, I didn't remember that, but now you do. Okay, just a quick picture, right? There's your deadweight loss. Here's the amount of the tax. There's consumer surplus. There's producer surplus. There's your deadweight loss, right? So remember that deadweight loss. That's something AP likes to talk about. All right, here we go. A little bit of calculations, okay? And feel free to try to calculate these with me if you can. Okay? Calculations. We know gas is $10. So we can sell gas. We pay $10 for gas. We pay $20 for this package of food, which right now, with having to deal with food and figure out what you can buy, is more meaningful to me than it normally would. Then you got to do the math. Okay? Well, this is about utils, right? We're trying to balance our utils. We're trying to find out what would we do to maximize our utility. We can see right here that utils per dollar, right? Remember, it's always utils are nice, but it's utils per dollar that really matters. Like, you get awesome utils from a brand new car, but you also pay 20 grand for a brand new car. So it's like, it's really, really expensive to buy a new car. So that's why we don't buy them all the time, even though, they make us really happy when we first get them. So we keep doing the same thing, right? What's the marginal cost? Well, there's another 10. And then another 10. In fact, all of them, the cost of each unit of gas is $10. Our marginal utility are these amounts. Now, if they gave us total utility, we would have to calculate marginal utility. But here they actually give us marginal utility, so we don't have to calculate it. So 55 divided by 10, that's 5.5. 51, that's 5.1. See how easy they made the math for us? That's 4.8. That's 4.7. And that's 4.6. We do the exact same thing over here. They've given us marginal utility. We know it's $20 each. Okay, and we do that. And we take 105 divided by 20. That's 5.25. 98 divided by 20, that's 4.9. 94, that's 4.7. 92, that's 4.6. And 90, that's 4.5. Okay, now that we've done all our little calculations, what we do is we got to say, how much do we have to spend? Well, you're going to spend $130. Okay, we always know we're going to buy one of each unit, right? So we buy this, so we spent $30, still plenty of money. Now you just look for utils per dollar maximization. Which is the next biggest number? Well, it's 5.5. We're going to buy this one. Well, we still got a long way to go. What's the next biggest number? 5.25. We're going to buy that one. What's the next biggest number? 5.1, followed by 4.9. Okay, real quick check. We've spent 60 here. We've spent 30 here, so we got a ways to go still. So we're going to buy this next one, 4.8. Next one, 4.7, and ding, 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 our first matching numbers. Well, AP loves for the numbers to match, so this is a good place to check. We spent 10, 20, 30, 40, 50 bucks. So there's 50. We spent 20, 40, 60, 80. There's 80. 80 plus 50 is 130. We spent all of our money and we maximized our utility, because if we bought more of this, that number's less. If we bought more of this, that number's less. So we maximized utility per dollar. That's how it works. Okay? Does the combination G equal 1 and F equals 6 satisfy the income constraint? Okay, well, G equals 1, that's 10. F equals 6, that's 120. So yes, it does. It adds up to 130. Can Frank purchase this combination with his income? That's actually the definition of the income constraint. So the answer is yes. Is it utility maximizing? No, because that's utility maximizing. So there's only one of those. So that's a no. In which direction would Frank like to reallocate his purchases? He wants to buy more gas. What's Frank's utility maximizing combination? It's 5 gas, 4 food. Okay, that's how all that works. All right, still no questions. Good, awesome. It's hard to ask questions in this environment. We're going to move on. Those are the answers. We already did those answers. Okay, just a couple more little things. All right, here we go. A little bit on costs. Okay, this company sold 10 widgets at $10. They purchased for $3. They pay $30 for rent, and they have $20 in depreciation. Plus, the owner could earn $40 if they were willing to teach freshman English. Boy, that's a tough one. Okay, we have some questions. Total revenues. Well, total revenues is price times quantity. Price times quantity. 10 units times $10 equals $100. Fixed cost. Rent of 30 and depreciation of 20. Okay, that's $50. Accounting profit. Well, we also have to subtract the cost of widgets, right? So the variable cost is 10 times 3 equals 30. So accounting profit is 100 minus fixed cost, 50, minus variable cost, 30, equals $20. And so it's like, cool, I'm making $20. I'm doing good. That's what the accountants would say. The economists would say, well, how much could you earn? Well, I could earn 40 if I was teaching. You have to subtract the opportunity cost. So take your accounting profit of 20, subtract the opportunity cost, and the owner could have made 40. So they're actually losing $20. Okay? They're losing $20. So everybody good? Got one more thing we're going to do. Mr. Latham, part of the screen is cut off. Darn. At the top? Oh, yeah. Thank you. You're a good egg. And I think, did that get it? Yeah, you wouldn't believe. I've got a little book holder with a stapler pushing it back and my Surface Pro sitting there. Is it good now? Fixed it. Thanks. All right, cool. And we've got just one more thing to do, and we're out of here. And you're going to get really punished with this one. All right, here we go. This is an actual FRQ, and I think we've actually done it once, if you remember, but it's pretty hard, so doing it once may not help you. Okay, here we go. Volleyball's total benefit. Well, anytime we have a benefit, there's generally a cost too, so it'd kind of be nice. We need marginal benefit, and we need marginal cost. Okay, well, for zero, there's no such thing. Okay, but for one volleyball, there is. What's the marginal benefit for one volleyball? Well, it's $50. Okay, marginal cost. Let's see if it tells us. It says, assume the price of each volleyball is $9. So the cost of every volleyball is $9. 99999. Each one's going to be 9. Okay. The marginal benefit of the second volleyball, well, there's 95, but we already had 50, so 95 minus 50 is 45. Third one, 125 for total 125, less the total for 2 is 95, so that's 30. 146, 125, that's 21. Hey, notice how all these numbers are higher than 9? So we're going to keep making these, aren't we? Because we're making money. This one, 156, 146, that's 10. Still doing that one. This one, 160, 156, that's only 4. And then this one's 1. Well, guess what? You already know I'm not doing this one. I'm not doing that one. So I'm not doing the 6th. I'm not doing the 7th. I don't even know if they're going to ask me that, but I already know that's true. Okay? So it says, calculate Carrie's total consumer surplus if she buys 2 volleyballs. Okay, show your work. Well, for 2 volleyballs, it's $95. Okay, so $95. It's surplus, it's got to be what she got above her cost. Well, what's her cost for 2 volleyballs? Well, 2 9s, right? So 2 times 9 equals 18. Well, we got to subtract that, right? Total value, total benefits, 95, less the cost of 18. So that comes out to $77. So for 2 volleyballs, her total surplus would be $77. So she'd be really happy. You know, I would have paid a lot more for those volleyballs. I'm glad I only had to pay $9. How many volleyballs should Carrie buy to maximize her total surplus? Explain using marginal analysis. Okay, well, it's right here, right? She's going to buy this many because $10 is greater than $9. So she's willing to buy the 5th unit. The 6th unit, the marginal benefit is less than the cost, right? Marginal benefit greater than cost, it's not. So she's going to go with that. Okay, next questions. Assume the market for volleyballs is perfectly competitive and that soccer balls Soccer balls are a substitute, right? So you can buy either one. Correctly labeled graph of the volleyballs. Okay, that one's super simple. You literally supply, demand. This is volleyballs, right? They said label this P1, P1, label that Q1. Ding, 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 got it. If the price of soccer balls decreases, okay, so soccer balls get cheaper, what's going to happen? Show the effect on volleyballs. Well, if I can buy either a volleyball or a soccer ball's cheaper, guess what? I'm going to buy myself some people are going to buy themselves soccer balls. The demand, I'm going to switch my color here. The demand is going to shift left. There's D sub 1 and D P sub, we're going to make that P2, so I'm going to call that D2. And it says, show the effect on the price and quantity. So I've shown the effect on the price and quantity on the graph. So we're good. Assume instead that a 10% increase in income causes demand for volleyballs to decrease by 5%. Calculate the income elasticity. Okay, they actually give you the percent changes, so that's super easy. Quantity on top. What was the change in quantity? 5%. What was the change in income, right? Income, 10%. Okay, and by the way, this is income, so we care about the sign, and we make more money, but we buy fewer, so that's negative. Okay, 5 over 10. So calculate the income elasticity. Does the value of the income elasticity indicate the volleyballs are normal good or an inferior good? They're an inferior good because the calculation is negative, or you could have said because income increased and the purchase of volleyballs decreased, they're an inferior good. And that works. Okay, that's today's lesson. Remember, Monday will start for real. Make sure you have modules 30 and 31 done. We're going to go over the modules. We're going to do some cool stuff like that. Please make sure you're doing social distancing and all that good stuff. Take care of us old people and take care of yourself too, right? There's some dangers even for young people they're finding out, but mostly take care of us old people because I'd like to live a few more years. I'm not ready to go yet. But do what you're told to do. Good luck in school, and we will see you tomorrow when we will talk about perfect competition and markets a little bit. All right. Once again, it'll be half an hour tomorrow. Take care and so long.